Good morning. Happy Monday to everyone. Happy summer. Hopefully everyone stayed out of the heat this past weekend. It was kind of oppressively hot. It was, I think, 98 degrees on Saturday. And looks like today is going to be in the 90s as well. So hopefully you guys are staying cool and you're inside for this webinar. So that's at least a plus. You're in the air conditioning watching this, and we'll definitely try to keep this to an hour, potentially less, depending on the questions that you all have. As always, like, the most important part of these webinars is making sure your questions get answered. And so just as a quick reminder, if you do have a question, there's a Q&A button that you can click on the toolbar at the bottom of your screen. You can type in your question. If you don't care about your name being shown, you can just leave it as is, or you can check off toggle to anonymous to ask the question anonymously. And then it will go into the queue. We will see it, and then we'll make sure we answer every question that comes in. We'll try to leave the last 15, 20 minutes for that. So if you have questions, just jot them down, put them in the Q&A. There's no bad questions. What we're going to talk about today is something I feel like over the last several years has really been at the forefront of a lot of our clients' minds and a lot of the things they're concerned about, which is inflation. So we're going to talk today about inflation and its impact on retirement planning. So real quick, just to make sure before we get started, can everybody hear my voice, see my face, and see the screen? Yes, getting some yeses, good. Great. Okay, I'm going to go ahead and proceed. It looks like there's a number of people who are kind of signaling that they're good to go. So as always, we have to start with the disclosure, right? This is a webinar for informational purposes only. And to the extent historical performance is mentioned, it is not indicative of what's going to happen. It doesn't guarantee any sort of future result. And we're not CPAs, we're not attorneys. So if you have if you're seeking legal advice or something very specific that's tax oriented, this is not for that, right? Everything we've put together here is believed to be accurate. If you have any questions or anything is unclear, please ask us. But it's important to note that this is not to be taken as investment advice. Okay, so we can see in the graphic there, you have two retired clients who are not happy about the prices of things going up, look very concerned. And that's what we're going to talk about today. So we're going to start with kind of understanding inflation. What is inflation and its historical trends? Some strategies to protect retirement savings from inflation, different investment options that may perform well in inflationary periods, talking about what you can do, right? Because there's only so much control you have, but where you have control, how can you respond to an inflationary environment? And then we'll open it up for Q&A. Okay, so just looking at inflation over a long period of time, what we see here is, first off, let's start with what is inflation, right? So inflation is the changes in prices of a certain basket of goods and services, which comes from surveying thousands and thousands of households. So if we look back at inflation going back to 2000 through 2024, inflation has averaged about 2.56% per year. But that has not been linear, right? Some years it's been below 2%. And in years like 2022, it got up to like 9%, right? So it can be volatile. What's interesting to note is if you were to say, how much is my dollar, right? A dollar that I had in 2000, what would that have to grow to purchase the same Snickers bar, let's say, in 2024? And the answer is it would have to grow to $1.82 to buy the exact same item. That is inflation, right? The value of your money decreasing over time. What's more interesting to me is how much of that was weighted in the last 5 years. A dollar in 2019 would cost $1.23 in 2024. So of that 82% kind of cumulative increase in inflation over that time frame, a quarter of it happened in, right, a little more than a quarter of it in just the last 4 to 5 years. So, and that's where you can kind of see this up, steeper trajectory, right? Because inflation was rising much more rapidly coming out of the pandemic for reasons we're going to talk about. It is moderating now, right? So you can see here, this is over CPI and course, not cumulatively, right? You can see it kind of got up to 7 to 10%, and then it's been trending back down. It's not back down to where it was in most of the 2010s, right? Where it really was 2% or even sub 2%, got down to almost zero negative during the beginning part of COVID. But it is moderating, but it's at a slightly more elevated level than in the past. The other thing to remember is inflation doesn't affect everyone the same way, right? The goods and service weights may not be perfectly representative for you and your situation. If you have a young family with kids, they're going to be much more impacted with education and college inflation and things like childcare, right? The prices of those things going up. Whereas for someone who's retired, right, it's going to be more about what's happening with healthcare costs, what's happening with the flights where I want to travel between my two homes or travel to see family or go on a trip. And so depending on kind of where you are in your stage of life, that's going to greatly impact your subjective experience of inflation. In terms of putting this historically in context, the last really big inflationary period that we dealt with was back in the 70s and early 80s. And we have, many clients who lived through that time period. And some people have repeatedly kind of, because they've been scarred by that time period and how horrible inflation was, they kind of want to know, are we entering into a period that's more like what we saw in the 70s and the early 80s? So we're going to talk about that. The short answer is we do not think so. Okay, we definitely do not think so, and we're going to explain why. But it is important to understand the differences between those time periods, which is why we think the way we do about it. So let's compare and contrast, right, previous inflationary periods to today. So the big previous period of inflation really wreaked havoc was in the 70s. Okay, in the 70s, inflation was driven by some major supply shocks in the oil markets, namely 1973 and 1979, which led to substantially higher energy prices. Today's inflation is really primarily driven by excess demand outpacing supply due to the pandemic-related disruptions that occurred. And, let's not forget, the government injected about $5 trillion over the course of COVID into the economy, directly into people's bank accounts. That's a lot of money. Okay, the entire economy is a little over 20 trillion. So like 25% of the economy, just boom, the government just transferred money into people's accounts. And monetary policy was basically like the Fed went to zero and was going to buy any asset at any price. Frankly, given how fast the vaccine was done, completed in a year, got rolled out, it's a little bit surprising looking back, having a little more context, that inflation wasn't worse. I know that you probably don't want to hear that, but I mean, it easily could have been much worse. It's not, it hasn't been benign by any measure, but I think if you look back to how bad the 70s was, it could have been a lot worse. I mean, interest rates during that time period got up to 15, 16%. And we're sitting at like 5.5% today with where the Fed is. Other major differences, right, in terms of the inflation causes is the level of global trade, the economic integration of world countries was much lower in the 70s than it is today, right? There's been a huge increase in globalization and trade and labor arbitrage that have acted as disinflationary forces in recent decades. In addition, the economy today in the US, right? We're 50 years past where we were in the 70s. And the economy in the 70s was much more driven by a manufacturing base, right? It was manufacturing centric, it was energy intensive, so it was much more vulnerable to these shocks in commodity prices. Today, if you think about the economy, it still has a manufacturing, but it's kind of flip-flop from where it was in the 70s. Today, it's much more information based, right? Service oriented, and a lot less energy intensive. There were a lot more unions, and unions controlled a lot more of the workforce then than they do now. So, right, when you had a lot of baby boomers in the labor market, right, because they were graduating college and going to the labor market at that time, a lot of the work was unionized, and right, as prices started to go up, it could create some of these inflation spirals where, okay, we have to pay our workers more, so we're going to raise our prices, which passes it on to the consumers, and you get this kind of vicious cycle. Now we have seen a little bit of that today, through this bout of inflation, but the labor market has continued to remain strong, but it is softening a little bit. There are different larger kind of labor market dynamics at play today, right? One is we do have more of an aging population with more people leaving the workforce, and there has been kind of a shift towards more automation. And that's very likely, right, in the next 3 to 5 years to accelerate with AI coming online in more and more ways. We're already seeing examples of that. We've told you all the story of the Wendy's in Ohio that has an AI-only drive-through ordering option, and already the early data points are really positive for AI that it's makes less mistakes than a human and is less expensive, right? And it's faster. So, that's if you think about it, right, that is definitely a disinflationary force in the economy, AI. In the 70s, Saudi Arabia, US dominated oil production. So OPEC had a huge amount of influence. Today, there are more diverse energy sources and producers, reducing the impact of any single actor. Still fairly dominant in those areas, but it's more diverse now than it was. So these are some of the big reasons we see a difference between that inflationary period and today. Now, having said that, if the Federal Reserve isn't cautious, right, and lowers interest rates too fast and by too large of a margin, you could see another spike in inflation. And so I think that they are taking the lessons from the 70s and the 80s and these periods of inflation and being extra cautious, which could result in the economy slowing a little bit more than they might want. We'll have to see how the next 6 to 12 months play out. But so far, at pretty high rates relative to recent history, the economy has stayed quite resilient. I think it's surprised almost all economists. Certainly every economist I listened to during COVID, coming out of COVID, thought that rates at this level now that we're basically a year into it, because that basically was a year ago when they got to these levels and they've just held it, it would be in worse shape than it is. So, I mean, look, let's focus, a little bit of focus on the positive, doesn't hurt anyone. We're not saying everything is gravy, but, people can now get yield from fixed income they couldn't before. The market is still at it's at all-time highs. Okay, we'll see where it goes from here, but it is still at all-time highs. So it's not all bad. What causes inflation, right? There's a famous saying, too much money chasing too few goods, right? Too few goods and services. That's like a demand pull inflation, right? People have this money, they have a demand for goods and services that is outpacing, right, the number of goods and services being provided, and so prices go up, right? Prices go up to kind of try to reach equilibrium. Cost push inflation is where the manufacturers, the people who are making products, their input costs, right, the raw materials that go into them making that product or service, increase, right? For a service business, it's like labor costs are going up. Right, so the rising cost of production raw materials results in what? Them setting higher prices, right, to try to pass on some of those costs to the consumers. Otherwise, their margins get hit. That means the owners make less money, or the stock doesn't do as well because the earnings are down. So this is how they have to deal with it. And then probably the most insidious form of inflation is when it gets entrenched. Right? And you hear Powell talking about that. We don't want inflation to get entrenched, because when inflation gets entrenched, people start expecting prices to go up. And when they expect prices to go up, they say, well, I'll just buy it today because it's be higher in the future. And you have this self-fulfilling prophecy. of what happens with inflation. And wages and wage price spirals are kind of the biggest driver of this, right? When people can get a job and they can get a big raise from where they were before, right? All of a sudden you get this situation where how does inflation get controlled? Now that's starting to soften a little bit, but I think it's still something that's going on in the labor markets in certain areas. Okay, so let's just take a look at like a modest inflation rate, right? Let's just say 2%, which is about what it's been over the last 24 years. People say, inflation, I'm retired. I remember before inflation really spiked, there were people who said, that's not a real concern of mine because I'm retired. And, you know, if my money goes down a little bit in value because of inflation, what's the big deal? And I think the big deal is that it is kind of one of those slow tapeworms that just eats away, and you don't even realize it until all of a sudden you look back and say, "Oh my gosh, like I had $100,000 in this bank account, and now it still says 100,000, but after 25 years of 2% inflation, it's only going to purchase about $61,000 worth of the things I actually want to spend it on." That's a pretty big drop, and that's only at 2%. And so where this really plays a role is when we're doing retirement planning and clients have fixed income, right? Meaning a pension that doesn't have a COLA increase, an annuity that something they annuitize that pays a set amount and it's going to be that same amount throughout their entire retirement, right? So in those settings, those are still valuable income sources in retirement, but we have to be mindful to offset, right, over time, that income is going to purchase or be able to fund less and less of their retirement because of inflation. So it has to be made up for in other parts of their assets, right? In their portfolio, their real estate, et cetera. The other thing is as retirees, one of the costs that becomes a bigger and bigger portion of your budget is healthcare. And healthcare has pretty consistently been an inflationary force that has exceeded overall general inflation. Okay, and we would expect that largely to continue, just because you're seeing it with Medicare, right? The Part B premiums are going up. If you look at IRMAA, right, a lot of clients are stunned when they see these extra costs they have to pay to Part B because of their income level, even though they're retired. And so those are all forms of, I think, inflationary forces as well that are occurring. And it's not a good feeling, but we can account for it, right? We can plan around it, we can plan for it. And by having a plan and reviewing it regularly, you position yourself much better to deal with these inflationary forces, especially when they're unexpected. This is a really interesting chart that Jeff found, breaking down different categories that go into the inflationary bucket, whether it's food or healthcare, education, and looking at it based on age cohort, right? So under 25, 25 to 34, 35 to 44, et cetera, and looking at what percentage does that category make up of their after-tax income. And really what's most interesting, right, is inflation for people, 55 and below, they're much more affected by inflation related to things like housing, right, education, things of that nature. Whereas for people 55, 65 and older, healthcare becomes, right, it's a very minor part of your expenses, during your working years when you have a family, but then in your older age, it jumps significantly. Okay. And so I think that's a big, food away from home is more significant when you're younger, but when you get older, you're not going out and eating as much, especially kind of 75 and older. This shelter number is really heavily influenced by people when they get much older, needing long-term care, going into assisted living facilities or continuing retirement care communities where just the cost to live there is higher. But in general, right, when you're kind of in the 45 to 65 range, your housing costs are less because you're presumably on more of a fixed mortgage or your mortgage is paid off, right? So depending on your age and your stage of life, different categories are going to affect you very differently. And our focus for retirees is on really the healthcare front. The healthcare front is one of the biggest that we need to keep an eye on because the expenses can get so high as you age through retirement. So what strategies, right? What historically has worked well to protect retirement savings from inflation? Well, one is it continues to be important, in our opinion, to have a diversified portfolio. And that's not always super appealing. And the reason it's not super appealing is in a market like we have today, you have a very narrow subset of securities, mostly big technology stocks. And even if you wanted to get more granular, you could say one stock that focuses in AI with NVIDIA, where the performance is just so extraordinary that people have this fear of missing out. And they just say, well, why do I have all this other stuff? I just want to own this one thing because it's just going up. But the reality is, and what we learned is in the short term, that can be true. But if we look at over longer time periods, 3 years, 5 years, 10 years, things that were in favor before and the only thing you wanted to own, they go out of favor, right? Intel in 2000 was the NVIDIA of its day, right? And today it's struggling, trying to be relevant. So by spreading your assets out across a number of different asset classes, stocks, real assets like real estate, fixed income, especially higher yielding fixed income that pays a higher income stream, inflation protected securities, you might not have as good a return in any one year, right? But what you're doing is you're saying, I want to have a good return in a somewhat more smooth or linear fashion than riding these really big up and down waves. And I think diversification still provides a very valuable role, especially actually in an environment like we're in today, where it just seems so easy to throw money at a couple tech stocks and basically feel like you can forget about it. And probably the biggest lesson for people who forget was only 2 years ago, all those big tech stocks, including NVIDIA, were down 50+%, right? I mean, if you were looking at the summer 2022, Meta, also known Facebook or Meta, I think was down 75% in that 1 year, intra-year. NVIDIA was down 60 to 70%, Amazon 50+%, Microsoft 40+%, Apple. These are really, really, really big drops that occurred very fast in 1 year. And I think people have already forgotten that, right? They have forgotten that those types of things can happen when expectations change. And frankly, things that happen that are unexpected. So I really do believe diversification has a role and should have a role for any client who's in retirement or even younger. Other strategies that you can do. If you are in your mid-60s and are looking at taking Social Security, one of the things we emphasize is delaying the higher earning spouse's Social Security beyond full retirement age. So full retirement age is 67. If you don't take those benefits until 68, your income will go up by whatever cost of living was, plus you'll get a delayed retirement credit of 8%. Well, that's a really good way to help offset inflation. And each year you do that up until age 70, you get that 8% increase, which is why we generally are very big proponents of delaying that higher earning spouse social until the last moment, because it serves as longevity insurance. It's a direct inflation hedge. Okay. Look, holding cash, I get it. It gives you peace of mind. It's nice to know if something happened, I could take this cash and pay for this bill, pay off my mortgage, whatever. And there's a place for it, 100%. But what we want to avoid is having so much money in excess cash, hundreds of thousands of dollars sitting in a checking or savings account earning zero. That's where if you do that and you just let inertia kind of take hold over 3 years, 5 years, inflation is just going to slow, like that tapeworm. It's just going to eat away. It's going to eat away at what that money can buy for you. So it has a place, but anything above kind of that reserve, we don't think makes sense to just sit there idle. I mean, even if you're buying just short-term treasuries or a money market fund that's paying 4 or 5%, that's good, right? That's outpacing inflation right now. If you're right on the fence of retirement, you're nervous about it, you could look at, hey, what if I work part-time for an extra 6 months a year? I'm not saying to do this, but this is a way to mitigate. Or you delay retirement by 6 to 12 months. And then just having more regular check-ins to adjust or rebalance your asset allocation based on inflationary trends, we think is a healthy thing to do. I mean, you look at healthcare as a sector today in stock market, you look at utilities as a sector today in the stock market. There's some, I think, some strong fundamentals behind many sectors in the market, including those two, but they're largely kind of being ignored because everyone's focused on the Magnificent Seven and AI. And you know what? AI, what's happening with generative AI is a breakthrough. There's no question about it. There's no question about it. This image right here was created using AI, right? Person's pulling his hair out. What do I do? Inflation. Oh my gosh. Stocks, bonds, mutual funds. What do I, right? So it is going to play a role. It is going to transform how the economy works. But just like when, the Ford came out and then the cars came out, there were hundreds of different automobile companies. This is going to change the world. And 3 survived, right? 3 survived. So just because you have something that's going to have a tectonic shift in the way people work, in the way society functions, doesn't mean that every AI investment is going to work in the long term. It just doesn't, because a lot of that stuff, I remember Buffett or Munger talking about the internet when the internet came out, and everyone was saying, "Oh my gosh, these companies would be so much more profitable, and you got to invest, you got to do that." And Munger, who's passed, I think early this year, sadly, right before his 100th birthday, but he said, "Warren and I realized that almost all of that would not stick to our bones." And what he meant was that while the internet had transformative properties, the question is, where do the excess profits show up? Do they end up in the company's shoes, or do they ultimately get passed on to the consumer in terms of cost savings? And that's what happened, right? A lot more of it just ended up getting passed through and not sticking to the company's, it didn't end up in the earnings of the company. It ended up getting passed through. And that's the same thing that's going to happen with AI. Some companies will be able to capture that surplus, and it's going to be durable and stick to them. Right now, the market's saying that's NVIDIA, right? The market's saying that that's Microsoft, right? I think there's good reason to think that. But at some point, right, the prices of these things can get to a point where it just doesn't make that much sense from a probability standpoint to say, I'm this sure that this company is going to do this much better than the overall market because of AI. So, I know I'm going on a little bit of a tangent here, but I just want to emphasize it because that's all I feel like I get questions on or hear about these days. So again, we're big fans of taking a longer term perspective, especially when times are good, right? Because it's harder to do that when times are not good. So investment options that have or may perform well during periods of moderate to high inflation. Stocks, again, over the long term are, again, emphasis on long term. We're going to look at some data, but they're great. A diversified pool of stocks, we still believe over the long term, is a great way to hedge inflation, and we'll point to the data behind that. During the bouts of inflation, sectors like energy, utilities, and some growthier parts of the market, like technology you're seeing today, can be very good ways to hedge inflation. Real estate, right? You've all seen your homes appreciate dramatically in value since 2019, since COVID. And to the extent you're renting out a piece of rental real estate, you can raise rents more easily in an inflationary environment. Commodities, right? So gold has done fairly well in this environment. Silver, not quite as much. Other commodities did really well early 2022 and then have kind of faded. But companies that have kind of their business models where commodity is the end selling point, like an energy company, right? It's going to be linked to the price of oil. That's going to be a decent inflation hedge during these environments. And then inflation-linked bonds, or just bonds that pay income based on, if rates are higher, they may actually pay a higher rate of interest. So inflation-linked bonds, think something like a floating rate loans. Those are things that we have in the portfolio for some of our clients. Over longer time periods, right, 10, 20, 30 years, stocks have outpaced inflation. from 1993 to 2022, the after inflation, so the real or inflation adjusted return was 8.5% per year for the S&P 500. That's incredible. That means your money approximately is doubling every 9 years after accounting for inflation. So the actual purchasing power, that's phenomenal, right? And that was a good period for the markets, but we had some huge drops in there. We had the dot-com bubble, we had 08 financial crisis, and we had COVID. So year to year, it's a little bit of a crapshoot, right? Most of the time the market's up, right? You can see here, right? 23 out of 30 years, the past 30 years, the market was positive after accounting for inflation. The US stock market was, right? So 7 of those years, you'd be doubting that because you're sitting there saying, inflation's up, my stocks are down, this is not working. But, right, that's the importance of looking over the longer term. More recently, going from 2000 to 2024, 100, and that was at the dot-com peak, right? That was a bubble in the market. So it's measuring from a very, very high point in the market. If you put in $100, you would have exceeded inflation by almost 5% per year, leading to an increase in purchasing power of $204. So more than 200%. Again, not every year would you have exceeded it, but I think that's a really good testament to the power of stocks in the long run. The most important point, right, is your time horizon. Right? And having a long-term perspective when investing in stocks is I believe it is the most important input as a driver of being a successful stock investor. I mean, Buffett, the first thing he talks about, right? We're buy and hold investors, because he knows that over time, stocks are going to trend upwards. And so if he can just be patient, or more patient than most, he's going to be a winner in the end. And that's the point we all want you to embrace that. Even in retirement, right? You do have a fairly long time horizon. You're 65 or 70. We got to make sure the money's there at 90, 95. And so we think in general, not for everyone, but this is why we believe stocks have a place in retiree portfolios. So this is a nice kind of chart, just again showing, going back to 2000, what's happened with the value of a dollar, right? Because of inflation. And you can see the value of a dollar has basically been cut in half. Excuse me, this is going back 30 years, right? So if you just had a dollar that was sitting in an account earning nothing, it would essentially be worth 50 cents today, okay? Whereas if you had invested that money over the last 30 years in US stocks, okay, broadly speaking, after inflation, you would be up cumulatively around 840%. Now, that's a great story, right? And it's true, but there are periods, 2000, 2002, right in here, 2008 to 2009 in here, COVID here, 2022 inflation scare here, where you're going to doubt, right? It's very easy to doubt your strategy during those time periods, because it's much more painful, like we've gone over in these webinars, it's much more painful to lose money than it is pleasurable to gain money. It's just the way we're wired, right? It's a survival instinct. But that's why we're doing this. That's why we do these educational webinars, is to emphasize the importance of not looking in a 1 to 2 year periods, but looking over much longer time periods. And again, in terms of what you can control, right? You can't control what the market's going to do. You can't control inflation, but you can and do have some control over your spending, right? So taking a look at, hey, what did I spend over the last year? Overall, what were the general categories? It doesn't have to be granular. If it is, great, but just having some sense, and then looking and saying, well, what expenses were essential, right? My utility bill, my health insurance, my mortgage, my insurance premiums, and just you kind of want to add that up and see where are my essential expenses and how much of my guaranteed income and Social Security or my FERS, CSRS pension, or employer pension, right, or annuity that I have meet those expenses. And then the other expenses, right, that are above and beyond that are your discretionary expenses, right? Going out to eat, traveling, giving money to charity, gifting money to the kids. And those expenses, I think, during these times where you have really high and unexpected inflation or persistent inflation, you can be more thoughtful about, what you want to do with those discretionary spending. As much as possible, what we try to do in the plans is have kind of the fixed income portion of the portfolio, the Social Security, the pension, cover the essential expenses, and then the portfolio that's invested, in a diversified manner between stocks and bonds. That's really, ideally, that's to generate the money to cover the discretionary expenses, right? And so if the market's down like in 2022, we had a lot of clients, because they went through the plan we're working with, where they said, I'm not going to do that second trip this year, or we're not going to spend money on, doing that renovation. They waited, they were patient, they waited. And I think that was a prudent thing to do. More extreme measures, you could tighten your belt and cost cutting, right? Downsizing, reducing certain costs that you have the ability to reduce. If you're still kind of right on the edge, you could work a bit longer or work part-time. But it all is a function of your particular plan, what your goals are in retirement, what type of flexibility you have, what are your concerns, all those things. So the benefits of planning for inflation is you're better equipped, right? Better positioned to maintain your purchasing power, so that your money, like we saw, is not just kind of losing its purchasing power and going down in value over time, but it's at least keeping pace with inflation. Hopefully this leads to more peace of mind, right? You're not as stressed about what's going to happen next week, next month, next year, because you do have a longer term perspective. And it will promote longer term financial security, because okay, this bucket of money is for my long-term care money. If something happens, we can always sell this house and downsize, or sell this house and buy directly into some sort of continuing retirement care community, so that our healthcare needs and costs are met. It's all about the plan. I like to also show this because I think now some of this is dependent upon what you have. This is for households that on average have 1 to 3 million of investable assets in retirement. And it shows the trajectory of their average annual spend by age. Okay. So the point here is, yes, inflationary pressures will cause expenses to increase throughout retirement. However, overall spending generally declines in absolute terms over retirement, because people don't spend as much. They generally spend the same amount or close to the same amount early on in retirement. So if they retire here, they basically spend, it goes down some, but not a huge amount. And then it continues to go down as they get into their mid to late 70s. And then by 80, it starts leveling off. For some people, it keeps going down, but it starts leveling off normally because of the green, right? Healthcare as an expense becomes a bigger and bigger portion. Could be assisted living, could be some home health care, could just be insurance premiums going up or out of pockets going up for more care that's needed. But that becomes bigger. But things like education, college go down, transportation goes down, right? Entertainment over time generally will go down. You're not doing as much travel, things of that nature. So it kind of represents almost like a slope and then a little bit of a smile or upward curve at the end, like almost like a ski jump or something. And that's important to keep in mind, is like, yes, over a 5-year period, inflation can be really bad and look scary. But in general, you're actually, as you trend through retirement, probably going to spend a little less overall. You'll spend more in some areas, but less overall on average. Okay, not everyone's going to fit this bill, but I think this is a lot of research has been done. This is from JP Morgan around this. And we think that from what we've seen, that this tends to stand true as well. So summary and key takeaways, right? What is inflation? Understanding its impact. How does it erode savings? What are different strategies we can use with our portfolio, with our spending, to mitigate the effect of inflation? adjusting regularly, right? Checking in, reviewing, adapting your budget and your plans to make sure you're continuously positioning yourself in the best way possible to deal with inflation. All right. I believe that is the end. So what we will do now is open it up to questions that you have. And I believe Jeff is also in the queue in the background here. So Jeff, if there are questions or comments or thoughts or anything you want to add, frankly, before we start addressing that, let me know.
No, I thought it was great. Thank you, Josh, for the presentation. We do have a couple of really good questions, some tough ones here to answer, and then we encourage everyone else to think about it and write in any questions that you also feel like are relevant to the discussion topic today. So the first one is the Fed supposedly watches PCE. I know in a lot of financial media, they talk about CPI as being kind of the inflation proxy. But the Fed also watches a different sort of inflation index called PCE, and that's what this person's referring to, not the CPI. Assuming yes, what significance should be attached to that considering CPI is followed in the media? So I think, I'll take a stab at this one. The Fed does kind of formulate policy around PCE, technically speaking, but they follow both, and both are very important. There are some kind of important differences between the two, which I think is why the Fed typically does use PCE in kind of dictating policy more so than CPI. And one of the reasons is the weightings are slightly different, but also CPI gets updated in terms of, as Josh mentioned, it comes from a survey from consumers, and they reweight that basket of goods every 2 years or so. And so if you think about what a consumer does is they may respond to different changes in prices next week or next month, or say, oh man, I'm paying too much on groceries, we've got to spend less here, or transportation is getting very costly to maybe hop on an airplane. We're going to drive instead. And so all of those substitution effects kind of get lagged in the data, so to speak, because they might change in response to a certain price change that's happening, but it's not going to show up in the weighting for another 2 years or so, potentially. Whereas the PCE kind of updates on a quarterly basis, and that kind of gives the Fed a little bit more real-time understanding of how prices are impacting kind of the consumption of goods and services. So that's a great question. It's not an easy one to answer. There's a couple other differences that are pretty significant. PCE and CPI, though, are very highly correlated. PCE just tends to be slightly kind of have a lower inflation rate historically through time than CPI, but otherwise they're kind of mirroring and kind of very, very much tied at the hip.
I mean, the PCE is slightly lower than CPI currently, right? Isn't it like in the high twos?
Yeah, that's correct. Yes, that's good. Second question is, doesn't inflation reduce the real cost to debt issuers, such as the government? You want to?
Well, I was thinking more for for a corporation, if to the extent a corporation has locked in, and Jeff and I were talking about this before the webinar. So many of these big corporations, and this is part of the reason we think stocks can do well over time despite inflation, is you look at like a company like an Apple or a Microsoft or a lot of these big companies, they locked in 30-year, 50-year, I think, wasn't there a 100-year lock-in for some crazy 100-year long bond, but I think Apple did like 50-year bonds, maybe.
I think Australia issued a 100-year bond.
It's Australia, okay. But they locked in rates at 2-3%. So if you think about it, they're paying interest right? It's a flat dollar amount. So to the extent inflation allows them to increase their prices from the debt standpoint, it actually is very helpful to them, because right, they're paying essentially inflated dollars on debt that was fixed from before inflation took place. Um, and then in terms of the government, I mean, I think part of what's happening, right, is that we are kind of gradually, I mean, it's not like intentional, but I guess it's just kind of a natural part of when you're spending too much is we're devaluing the dollar gradually is getting devalued over time. I mean, that's been the case and that continues to be the case. What's surprising though is if you look at the dollar, and Jeff, I'll let you weigh in here as well, but I think year to date the dollar has been one of the best performing currencies against almost every other currency in the world, correct?
That's correct. Yes.
So think about, so there's so much catastrophizing you see here in the news and read about the collapse of the dollar and all these things. We're not saying that debt to GDP at 120, 130% is a good thing and running these deficits is a good thing. We are not. But what we're not trying to do is just say, well, based on how we're spending and the level of debt, everything, it makes no sense to invest and you might as well put all your money in gold. I think that's a very that's the wrong conclusion to make. And I think the market's bearing that out today. When you look at the value of the companies in the US stock market, I think they represent 2/3 or 75% of the entire world stock market. Well, the US is only, from a GDP standpoint, not nearly that significant. So, and then you add in the dollar, and what it says is, well, things may not be great here, and we can certainly find many things, especially, downtown in Washington, to pick at and complain about. And I'm one of the first to do that. It's kind of the best, I guess you could say we're the best of the worst still. So I don't know, Jeff, if you have anything to add there.
No, that's a good summation. I mean, I think if you look post great financial crisis, the dollar's been in a very strong uptrend. And I think, I remember vividly going through the great financial crisis and everyone discussing how bad inflation was going to be.
Yep.
And then we always had periods where there's disinflation or deflation, and inflation basically since that time has kind of been running between 1% to 3%. And then we've had the post-COVID, obviously, uptick, which has been unpleasant. But I think if you look at the last 15 or so years, the dollar's been strengthening and inflation has been relatively benign, except for a couple of years after the COVID. So, next question, another good one. Didn't Milton Friedman prove inflation is caused by too many dollars chasing too few goods? Does this suggest the COVID money or stimulus was a contributor to the recent inflation bout? So, yeah, I mean, that's a monetarist interpretation of it. And for sure, I don't think anybody would ever doubt that the amount of stimulus that was poured into the economy during the COVID period contributed to inflation. I think it's debatable how much, but at the same time, I don't think any serious economist disagrees with the fact that it had a degree of impact. I would say also what contributes to inflation is the expansion of credit. And in the United States, at least, a lot of credit gets issued through private institutions like banks. So in other words, if you want to go out and buy a car, you don't have $30,000 to buy your car, you're going to ask for a loan. They just create that cash out of thin air. It's becomes an asset to you in the form of cash or bank reserves, and then it's also a liability that needs to get paid back through time. However, in the shorter term, that's fresh cash that can go to purchase something that otherwise wouldn't have been able to. So it's important to not just simply focus on kind of stimulus that comes in, but also the credit creation of private financial institutions as well. And one of the interesting things that's happened kind of in the post-COVID, post-great financial crisis world, but also COVID, is yes, there's a lot of stimulus, but there hasn't been a lot of credit expansion in the private sector and households, which is kind of unique to this period, because I think a lot of people have been focused on, the lead up to the great financial crisis and kind of the low documentation, low quality loans that were offered, but that really hasn't happened in the last couple of years. So yes, I think long story short, the inflation was a combination of a lot of federal monetary stimulus in conjunction with not enough goods that could be produced due to COVID restrictions, supply chain issues. So
And you had a massive war in Europe too.
that's very true. Very true. Those are all the questions so far, so we can hang out for a minute. All good questions, though.
Yeah, great. No, great questions. I think, a lot of people, when we have our reviews or we have our sit downs, we talk about these things. So I think some of them do get addressed. But it is interesting, like if you look at technology, how hard tech got hit during the initial inflationary scare. I mean, right, I went through some of those names and the declines, and some of the tech from COVID never came back, right? A lot of the work from home stocks, they just, they looked in the moment like they had a lot of promise and we're going to benefit from, scale that technology and the internet and all of that provided, but they couldn't deal with all of the inflationary pressures and the pressures from Wall Street, right, to produce profits now. But you fast forward 2 years, even a year and a half, and big tech in particular, right, it came roaring back. A lot of it was on the heels of kind of the whole AI story narrative and the breakthroughs happening there. But nevertheless, right, you would generally not expect technology in a real inflationary environment to do well. And my guess is if we looked back to COVID, beginning of COVID to now, tech would still be probably the best, if not one of the best sectors to be in. So it's very tricky. It's very tricky. You would think, oh, inflationary environment, energy, gold, I'll just sit there. That did work, right? At the beginning, that was the great place to be. And then that faded very hard as the market started to see inflation dropping and the Fed cutting rates. Now, inflation has dropped a lot, but it's still way higher than the Fed wants. And the Fed hasn't dropped rates, and tech's still done well. So this is why you stay diversified. This is why you're in it for the long term. I mean, it's when you start getting into the articles of the day and the news of the day, I would argue 90% of it's noise. I mean, the longer I'm in the business, the more I feel like it's noise. You read Buffett's letters once a year, you read someone like David Giroux's shareholder letters, where we have, most of, clients in that fund. And it just puts a lot of it in perspective. And both of those investment managers, they start at the company level. They don't start at the macroeconomic level. I'm not saying it's not important. There are certainly factors in their thinking, but they're looking at this particular utility company or this rail company or this energy company or this tech, and they're looking at, right, what do they actually do? Like, what is the product? What is the service? Where does the revenue come from? How volatile is it over an earnings cycle? What is management doing? How are they reinvesting money? And when you start at the company level and you do that company by company, it gives you a lot more confidence and conviction in investment returns over the long term, right? Because these companies are incredibly sophisticated. They are constantly innovating, coming up with new products and solutions. And I just think when you're looking at a news article about inflation of the day or the election, it takes away from what really drives the market. So I know that that's somewhat philosophical, but I strongly believe that.
Yeah. I want to just go back. I know we're kind of running out of time here, but to the second question about inflation reducing the real cost of debt. And I think it's actually even better than that if, a lot of companies, you mentioned the larger tech companies like an Apple, for example, or an Alphabet, which has a tremendous amount of cash on their balance sheet. Not only were they able to lock in,
Yeah.
there's like a kind of a three-pronged kind of tailwind here. One is they locked in low cost of debt, 3-4%, something like that. Two, they're raising prices on their sales, right? At current inflation rates, which are high, right? Historically speaking. And then the third piece is if you are not incredibly indebted and you have a low fixed rate on your debt, now all of a sudden you have all this cash balances that can now earn kind of the higher cost of interest that the Fed's allowing for, let's call it 4 to 5%. And now you're making money off of that spread. And so it really benefited a lot of these companies kind of in a different way that we've seen in a long time. I think a lot of people are anticipating raising rates due to the higher inflation, have really raising interest costs, which has certainly happened, I think, for smaller companies and medium-sized companies. But the larger companies with a lot of cash on their balance sheets, it's almost been a benefit in some ways.
And that all goes down to what we call capital allocation. So what Jeff's saying is, right, management, the executive team has to make decisions on how to structure the balance sheet, when to take on debt, when to make an acquisition, what to do with cash, right? Good capital allocation is not a given. And some companies are real stewards of capital and others make mistakes. And so, Apple, I think in general, has been a good steward of capital that way, right? Separate from just coming up with the iPhone and selling a bunch of phones and the services that they're now doing. They manage the capital and make capital allocation decisions wisely and looking at it over a long time period. No more questions?
No, that was all.
Good, everyone, your questions have been answered. We don't want to hear about inflation again. No, just you're always welcome to ask any question you want. Jeff and I ask a lot of questions when we're meeting with different managers and analysts. So, that's kind of in our DNA. I know a lot of our clients ask great questions. So, if something pops up after the webinar that you're curious about or want our thoughts on, just shoot us an email. But yeah, if there's no other questions, we're pretty close to the top of the hour, so we can go ahead and let you guys all go. Thank you so much. Love seeing you as always. See you next month.